What's up, YouTube? It's Matthew Decker, Leveraged Wealth Management. Hope you're doing well today. Today, we are talking about whole life insurance for tax-free income. So in our last video, we talked about using life insurance for tax-free retirement income. And we talked about things like Section 7702 of the IRS code that shows exactly where life insurance is actually classified as a tax-free asset, considering that it's structured properly. Okay, so we talked about that. We talked about how you get access to your money, and we gave you some useful stats on just how much money is actually sitting inside life insurance policies in the United States right now, and that number is a staggering number. It's trillions of dollars. It's actually sitting in life insurance right now because of these very tax benefits that we discussed last time. If you haven't seen that video, I'd encourage you to go watch it. We'll link it in the comment section below. Today, though, we are talking about whole life insurance as tax-free retirement income. So whole life insurance is probably the most widely understood and acknowledged form of cash value life insurance. It's been around the longest, and most people have some experience with whole life insurance, whether you've seen the commercials on TV or you were sold a whole life insurance policy as a juvenile, paying something like $100 a month, and now you've got maybe $15,000, $20,000 in there. It's by far the most common form of cash building life insurance in the United States today. And so we want to talk about why someone might use whole life insurance for tax-free retirement income. And I would actually go so far as to say whole life insurance is actually not built for tax-free income. Whole life insurance is built to be a tax-free asset. And there's a big difference there, and we'll get into that in a second. But the reason that someone would choose whole life insurance for tax-free income, or rather as a tax-free asset, is because it provides guarantees. They have the highest financial ratings in the life insurance world. Some of these companies have a Comdex score of 100 or 99, which is as high as you can get. And it's extremely low risk. So let's talk about the guarantees for a second. When it comes to whole life insurance, the types of guarantees involved in whole life insurance can be a little bit convoluted. So let's break it down. You have a premium guarantee, meaning there's a certain amount of premium that you can pay, and you can be certain that your policy won't ever go away. So there's a premium guarantee. You know what is required of you to keep this policy in place. The second thing is there's a cash guarantee. So your cash account is guaranteed to grow at a certain rate of return. Let's not confuse this cash guarantee with a dividend rate. Those are two totally different things, but we'll get there in a second. And then the third thing is there's a death benefit guarantee, which kind of goes hand in hand with your premium guarantee. You pay the premium, you are guaranteed to get a death benefit, and you are guaranteed to have some cash value in your account as long as you satisfy your end of the transaction. And so those are the guarantees that are involved in whole life insurance. Now, when most people see or hear guarantees, they immediately think, oh, that sounds great. I'm so glad that there's these guarantees inside this contract. But I want to caution you, anytime you hear the word guarantee in a fixed contract, you should immediately start thinking, this is going to limit my upside potential, because that's exactly how it's going to work. See, life insurance companies in general are treated totally different as a business in terms of what they are required to have in their cash reserves. Because if they provide to you a contract that is a guarantee, it means that they have to reserve cash to back the guarantee. So the more guarantees that a life insurance company throws onto their policy, the more cash they actually have to set aside and hold in the form of reserves. And if they are setting aside cash to hold as a reserve account for all the guarantees on their contracts that they're putting in place, you should immediately think and realize that's less money that the company has to invest and earn any type of rate of return on it. And if they can't earn a rate of return on that money that they have to set aside as cash to back the guarantees on their contracts, that means you can't earn a rate of return on that money. And so in whole life insurance, the guarantees can sound very attractive, and a lot of times you'll often get the guaranteed rate of return confused with the dividend rate, which those are two totally different things. So I just want to be crystal clear. This is why I say life insurance, whole life insurance is more of a tax-free asset. It is not necessarily the best source of tax-free income, because those guarantees are going to lower your upside potential, which in turn makes it more difficult to turn into an income stream. But we will look at that in a second. I want to really quickly show you what I'm talking about when it comes to these dividend rates not necessarily being the same thing as the rate of return. So what we're looking at here is a list of some of the biggest whole life insurance companies that are out there issuing business, and you've seen probably most of these names. We got Northwestern Mutual, Ohio National, Penn Mutual, we've got New York Life, Mass Mutual, John Hancock Guardian, Equitable, Emeritus Life. So a lot of big companies out there issuing lots and lots of business. And what this chart is representing is the annually declared dividend rate on these particular policies. So we're going to focus in on Mass Mutual. And the reason we're going to focus in on Mass Mutual is because they are the example that we are also going to look at. So I should say that Mass Mutual is a great company, highly rated. And when we do use whole life insurance, we will typically use Mass Mutual. Well, I shouldn't say we will typically use Mass Mutual. They are always in the running because they've consistently had a great product and they do a good job. So we're looking at Mass Mutual. This is not to pick on them. This is just the reality as it stands. So across the top, you can see we got 2005 to 2021 highlighted here, and we've got our annually declared dividend rate. We're going to look at the top row for Mass Mutual because this is for policies issued after, I believe, 1996. And so what you can see here is between 2016 and 2021, or if we go all the way back to 2005, we had a 7% annual dividend rate declared in 2005. It got as high as a 7.9% annually declared dividend rate. And right now we're sitting around a 6% annual dividend rate. And so if you were shown this chart, and by the way, we've got all kinds of numbers on this chart. Mass Mutual is some of the strongest that are on here. But if you were shown this chart, look at this cash value life insurance, this whole life insurance policy dividend rate from Mass Mutual, and you saw numbers ranging from the highest, I want to say is like 8.4%, all the way down to 6%. You know in your mind, okay, this is a fixed vehicle. I'm not actually investing in the stock market, and I'm seeing this dividend rate fluctuating between 8.4 and 6%. If you did no further research, if you had no more context than that right there, oh, and by the way, when it was presented to you, you knew that it was guaranteed. You would think this is an absolute no-brainer. Why isn't every single person in this country investing all of their money into the Mass Mutual whole life product that has a dividend rate between 8.4 and 6%? And that is a logical conclusion to come to if that's the basis of your context. If that's it, if that's all that you know about this product, you're thinking this is phenomenal. But it's important to know that when we look at these dividend rates, the way that the companies actually pay you your return is they're going to say, okay, well, the dividend rate for this Mass Mutual policy in the year 2021 is going to be 6%. Okay. The question that you need to ask, the question that every single person needs to ask who has a whole life insurance contract is 6% of what? 6% of what? Because to say that you're going to get a 6% dividend rate, that's only one variable in the equation. The other variable in the equation that you absolutely need to know is 6% times what number? How much of my account is getting the 6% rate of return? That matters. Of course it matters. If it was only half your account getting the 6% rate of return, it's not a 6% rate of return. It's a 3% rate of return. And so we all have to ask the question when it comes to whole life insurance policies, if you're getting seduced by a dividend number, you need to ask the question, 6% of what? Another way to say it would be 6% is that net of fees. And of course, the answer is no, it's not net of fees. And if you ask them 6% of what, they're not going to be able to tell you. So I'm going to do you the favor of showing you the actual net returns on these policies over the last 20 or so years. And it's really eye-opening and it's really shocking. So when we actually look at the 20-year historical performance, now this is from 1990 to 2010. So this performance is actually better than it would be today. And the reason is because if we look at these dividend rates, they are all higher than they are currently. So this is looking at a period in time where dividend rates were higher than they are today. So here's where we're looking, and we're comparing this illustrated IRR on the Mass Mutual product line, the illustrated IRR versus the actual IRR. So can someone in back read to me the illustrated internal rate of return for Mass Mutual? What this means is a policy issued back in 1990 had an illustrated internal rate of return of 5.94%. Now, if we go back to our dividend chart, you see here that in 1996, they had an 8.4% dividend rate, and it was roughly there all the way back to 1990. So an 8.4% dividend rate becomes a 5.94% internal rate of return. That means by the time you answer the question, 8.4% of what number, and is that net of fees, that 8.4% dividend rate turns into a 5.94% rate on paper. Let me say that again. It turns into a 5.94% rate on paper because they are future casting. They're saying this is what our dividend rate is today. If it stays the same forever and doesn't ever change, which it changes almost every single year, if it stays what it is today and it's the same forever, what's your illustrated internal rate of return going to be in 20 years? Well, in this case, 5.94%. But did dividend rates stay the same? No, of course they didn't. And so if you're considering purchasing whole life insurance and you have this idea about dividend rates and guarantees, and you think that somehow those two things go together, you need to understand that they do not go together. The dividend rate is not guaranteed. Some people will say, well, it might not be guaranteed, but we've always paid one. Well, if the dividend rate ends up with you earning $1, guess what? They can always say, we've always paid a dividend. That doesn't matter. The dividend rate is declared annually. The guarantees are typically less than 1%. Okay, so these two are not the same thing at all. And let's just look at how these policies actually fared. The actual internal rate of return. So what this means is when you actually tally up the dividend rates that were actually paid over that 20-year time horizon, and you compare it to what was on paper, the illustration, the actual internal rate of return was 3.74%. 3.74% on a product that had an annually declared dividend rate when it was sold above 8%. A 3.74% internal rate of return. On paper, it was going to be 5.94, but the annually declared rate was over 8. So can you see how we're kind of progressing into something that's very obviously not guaranteed, and it gets convoluted very quickly because of the terms that are used in whole life. So let me recap. Dividend rate is declared annually. It is not guaranteed. Dividend rate is not net of fees, and what is it applied to? You don't know. The whole life insurance company doesn't tell you. So if you see a 6% declared dividend rate, that is not a 6% rate of return. It's much lower than that. If we look at how these policies were supposed to perform, The Mass Mutual was supposed to do 5.94% on an internal rate of return basis. It did 3.74% on an internal rate of return basis, which is totally understandable because these are interest rate sensitive products. And over the 20 years in time that we're looking at here, interest rates have declined. And because of that, the actual performance of the product is worse. Super simple, super straightforward. So this is exactly why I say these vehicles are a tax-free asset, but they should not be considered tax-free income sources. And the reason they shouldn't be considered tax-free income sources, last time we talked about how do you access your money? Well, you access your money by way of policy loans. So I have a very simple, straightforward question for you. Of all these policies, at the top, Country Financial, Guardian Life, Mass Mutual, MetLife, Mutual Trust, New York Life, Northwestern Mutual, Penn, Savings, Security, State Farm, Thrivent. Of all these policies right here, given a 20-year track record, let's look at their actual internal rate of return, and let's count the number of policies that have an internal rate of return over 5%. 1, 2. Northwestern Mutual, Savings Bank Life of Massachusetts, which I'm not sure that they're even issuing this policy anymore. So really the only one on the board that is over a 5% rate of return is Northwestern Mutual at 5.11 over 20 years. Now, everyone out there who owns Northwestern Mutual and who is watching this video is like cheering to themselves that they made the best decision possible. And I would ask those of you who have Northwestern Mutual and are using it for tax-free income, I would ask you a question. And the question goes like this: how are you going to access your money from your Northwestern Mutual contract? You should know this. How are you going to access your money? If you've done a lot of due diligence and a lot of research, you'd probably answer that question this way. You'd say, I'm going to take withdrawals from my contract until I reach my basis, which is the amount of total premiums that you would have paid into the policy. And once I hit that threshold of withdrawing my basis, I'm going to take policy loans. And I would say that is the right answer. That's the best way to do that on that contract. And then I would have a follow-up question for you. And the follow-up question would go like this. Once you withdraw your basis and get into the policy loans, what is the loan rate that Northwestern Mutual is going to charge you on a yearly basis for that loan? And the answer on most of the Northwestern Mutual contracts, the answer for most of the Northwestern Mutual annual policy loan rates is over 7%. Most of them are 8%. So let me ask another question. If it's going to cost you 8% to loan money from your life insurance policy, and your Northwestern Mutual policy has an internal rate of return of 5.11%, are you making a good decision taking a loan on this policy at 8 when you are earning 5.11? And the answer, of course, is no. And that is why I would say that these policies are a tax-free asset, meaning the money can go in, it can grow very safely. It is a phenomenal CD alternative, without question. It grows safely. It does have guarantees. The companies back these policies with cash sitting in reserves. It's rock solid safe, without question. But if you have to access your money via loan at a rate that is higher than the internal rate of return on your policy, are you making positive or negative arbitrage? Negative arbitrage. You're losing money in that transaction. It's costing you more for the loan than you're actually making on the loan. And that's why these vehicles don't work well for tax-free income, although they're great as a tax-free asset. So let me show you an example of exactly what we're talking about here. So I've got a Mass Mutual policy, and this is going to follow the same basic design that we're going to look at all throughout this series on tax-free income using life insurance. We've got $100,000 a year going into this Mass Mutual policy for 7 years. And if we go all the way back here to kind of the front of this ledger, I just want to point out what we did. So here's our premium information. You can see that we got a really small base premium, $10,992. The majority of the cash is going towards this ALIR and renewable term rider, $84,000 and then $4,000 a year, which means, or is another way to say, we've got this contract, essentially as efficient as we can make it. Okay, so it can't get much more efficient than this. And then I want to point out just a few other things, additional things about this illustration. Number one, this is what I'm talking about. The dividends used in calculating these indices are based on the illustrated dividend schedule and are neither guarantees nor estimates of future dividends. That is to say, the dividend rate can and will change. In this particular example, the illustration is using a 5% policy loan interest rate. Okay, so it's not maybe as bad as Northwestern Mutual, a 5% policy loan interest rate. But if we go back to our Mass Mutual contract here, we're looking at a 3.74% actual internal rate of return through 20 years. So is 3.4 higher than 5? Of course not. It's lower. So 5% is the loan rate, but this rate may change on each policy anniversary date. So that 5% isn't even locked in. It's a variable rate that can move as things change, which is not what you want to hear in a policy that is already going to underperform its loan rate. Okay, and this is a good policy. I'm not bashing this policy at all. Here it is again. Dividends are not guaranteed. They're subject to significant fluctuations over the life of the policy. But let's get into the actual ledger here. $100,000 a year for 7 years right out of the gate. We've got a total death benefit of $2 million. If we go out to year 14, age 64 on this particular contract, you've put in $700,000. You've got $970 in cash value. That $970 can be accessed tax-free. That $970 is not going to generate 1099s. That $970 is not going to be included on things like college applications, FAFSA forms. It's not going to be included when you file for Social Security and have to tell them where all your money is. It's not going to be included when you talk about Medicare, Medicaid premiums being potentially surcharged. That $970 is in an asset that is extremely tax favorable. And if you were to put that $100,000 over 7 years in CDs and waited 14 years, would you have $970? I would say no. You're not going to have $970. So as a CD alternative, this is phenomenal. It's much better. You're putting yourself in a much more advantageous situation, and it's more liquid than a CD would be. So $970, a great tax-free asset, but from a tax-free income standpoint, this is generating $46,000 a year based on the $700,000 that went into this policy. That $46,000 is going to basically last for lifetime. It is going to be tax-free, and it's not going to have market risk. And if you go out to age 90, let's say, you've taken that $46,000 out every single year for retirement tax-free, and you've got total death benefit left over of $836,000. So on the face of it, if this was the only thing that you looked at, this is relatively compelling. You put in $700,000, you're getting out more than that in the form of a death benefit, and you got $46,000 a year for 5, 10, 15, 20, 25, 26 years. So on the face of it, this is a good transaction. The problem is when you actually compare this whole life insurance policy to other options that exist, you very soon realize that on an income basis, this is not the most efficient vehicle. And the reason it's not the most efficient vehicle is because you can't outperform your loan rate. And let me show you exactly what I'm talking about. So if we go here to year 14/15, I'm just going to take a snapshot of the cash value. You'll notice we're not paying any more premiums, so no more premiums going in. And we're just going to compare the cash value from year 14 to year 13. Very simple to do. All you have to do is take $970,851 divided by $926,850. and you come up with 1.0475. 1.0475. That is the rate of return on the policy. Here you go, 1.0475. Can you see it? You can't see it. Come on, there we go. 1.0475. And the reason it's 1.0475 is because that 6% dividend rate is not net of fees and it's not on the whole account. So 6% quickly becomes 1.0475, and that's 14 years down the road. It's worse in those early years. So to wrap up this video, I would say as a tax-free asset, life insurance, specifically whole life insurance, is a phenomenal CD alternative. You could convince me it's a phenomenal bond alternative. I could get there as well. However, for an income stream, it's not what you want for an income stream because it's not going to outperform its loan rate. That's not a knock on whole life insurance. It wasn't built to outperform its loan rate, okay? There are better, more efficient options available in the same space that we'll be talking about in a later video. So if you're being proposed a whole life insurance policy, if this is something that you already have and you would like it reviewed or you would like a second opinion, here's what you need to do. You need to go to our website, leveragedwm.com. You can go to the Contact Us tab on that page. I'll navigate to it now so that you can see exactly what it looks like. Leveragedwm.com and navigate to the Contact Us page. I'll put it up on the screen here so you can see it. This is us. You go here, Contact Us. You can see a little video of me back before I had facial hair. You can book a meeting with us to talk about whatever you may want to talk about in the cash value life insurance space, whether it's whole life insurance, index life insurance, premium financing. If you have questions in this arena, I am an expert. My team is full of experts, and we can absolutely help you. So if you need help, this is where you need to go. Otherwise, if you have questions that maybe aren't private in nature, go ahead, throw them in the comments section. Send us an email, whatever's easiest for you. If you haven't already done so, make sure you like this video, subscribe to this channel, click the bell. If you don't click the bell, you don't get notifications on when we post new content. And then stick around. We've got 1, 2, 3, we got 4, 5, and 6 more videos on this exact series, breaking down life insurance as a tax-free asset and tax-free income vehicle. So stick around for this series. Let me know what else you want me to cover, and I can't wait to see you next time. Take care.